sitting where we are now, we have this unbelievable opportunity, just like with the internet, when it was starting to emerge in the 90s, a solid regulatory framework allowed, the great entrepreneurs that we have in the United States to effectively compete on a level playing field. And that is what has led to, all of these, marvelous innovations. And so we're hopeful that right now is an opportunity for us to actually get a similar type of regulatory framework in place. That doesn't mean an easy regulatory framework, doesn't mean deregulation, right? It means setting clear rules of the road that entrepreneurs can then compete on. And we think that kind of competitive environment is going to be the thing that really helps the industry take off.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic. Today's show spotlights Miles Jennings, Head of Policy and General Counsel for A16Z Crypto, and one of the sharpest legal minds in the space. In this episode, we're diving into how crypto policy and regulation are finally starting to keep pace with innovation, from the way we define tokens and DAOs to the pending Genius Act for U.S. stablecoins, including how institutions are preparing for real-world asset tokenization. But before we do, just a quick word from our sponsors who make the Edge Podcast possible. If you've ever wondered what financial freedom looks like in the age of AI, meet Newton, a smart, secure way to empower AI agents to work for you without giving them custody of your assets. For a world beyond interfaces, built for autonomous finance within your own tailor-made set of guardrails. Follow Magic Newton on X and get ready to try Newton soon. Maple Finance is one of my favorite products in DeFi. It is a gateway to sustainable real yield powered by over $1 billion in AUM across USDC and BTC products. And now with Syrup USDC by Maple, anyone can earn institutional grade yield. For deposits of $1,000 or more now through May 31st, Syrup USDC holders have a shot at a $300,000 grand prize expected to be drawn in November. The more you deposit, the higher your chances to win. Learn more at syrup.fi, and thanks to Maple for supporting us here at the Edge Podcast and Edge newsletter. This episode is brought to you by SKALE, the next evolution in Layer 1 blockchains with a gas-free, invisible UX, instant finality, and robust security. SKALE allows for limitless scalability and has already saved its 50 million users over $11 billion in gas fees. Visit skale.space today and follow their journey on X at SKALE Network. Overwhelmed trying to manage your crypto and DeFi investments? Meet iYIELD, a free financial planning tool for crypto natives and yield farmers. iYIELD's dashboard compares returns from your DeFi positions side by side, providing clarity to help you make better decisions. iYIELD supports a growing list of over 16,000 tokens and 40 of the top DeFi and staking protocols across 17 blockchains, including Ethereum L2s. The best part is that iYIELD is 100% free, anonymous, and there are no ads. Check out iYIELD.com today to take control of your financial future. Hey folks, I wanted to tell you a bit about our sponsor, PYTH Oracles, your go-to source for smarter data to power smarter contracts. PYTH delivers real-time market data for crypto, equities, FX, and commodities to over 80 blockchains. With 120 plus major market participants like Jane Street, Binance, and CBOE, PYTH ensures secure, low-latency feeds trusted by 430 DeFi apps. You can learn more about PYTH by going to pyth.network, and thanks to the PYTH community for supporting us here at the Edge Podcast and Edge newsletter. All right, let's introduce Miles Jennings, Head of Policy and General Counsel for A16Z Crypto. Miles, welcome to the Edge Podcast. How are you doing?
I'm doing great. Thanks for having me, guys.
So we have you on because it's been a big year in terms of policy for crypto. It's been a big year for a change in the mindset around regulation, specifically in the United States, and that has ripple effects across the world. You are one of the most experienced legal and policy minds in crypto. You've been at the forefront of shaping how the industry evolves and, how do we define tokens? Like, how do we think about DAOs? How are they structured? How can regulation catch up with all the innovation in our space? So we're going to try to cover all of that today, or at least give people a bird's eye view. And so we probably should talk more broadly about some of the changes you've seen over the last few years. I want to call out, you've worked with some of the biggest VCs in the space, such as Paradigm. We have Pantera and now A16Z. So if you could give us like a highlights reel of like what have been some of the standout developments in the space from a regulatory or policy standpoint.
Yeah. So, I mean, I started my career 8 years ago when I was at Latham & Watkins, which is, a big international firm. And I, basically got started working for Consensus, and then, brought on Paradigm as a client and Pantera, and was working for a lot of the VC funds in the space. And so, I got a really good, broad view of basically what, people were working on. And that was, super interesting because it gave you, a good perspective into the cycles as they were kind of developing and what people were really interested in. I would say, the thing that really, pilled me on crypto was when DeFi started, becoming a thing. And I remember, I was representing Paradigm in various investments they were making, and I was trying to figure out like what the hell was going on. And so, I basically just took some money, dropped it into Compound, Uniswap, stuff like that. And then all of a sudden realized like, oh, wow, like, this is totally different than the previous cycle where all you could really do was, buy, tokens on a various, centralized exchange. So once you could start actually using these products, it made it easy to kind of start imagining what this could mean, for our financial system more broadly. And then, all of the waves, since then, right, in 2020 and 2021, when we started to see kind of the emergence of, Web3, right? So, basically, existing Web 2 kind of products being re-released as Web 3, so things like social media and stuff like that. I think it just opens up the possibility of really what crypto means, and I think very hard for someone like me that was a lawyer, policy person, right, to imagine what this technology could be used for without actually being able to see it and touch it, right? And so with each of these cycles that have come along, right, actually being able to see, oh, wow, like you can now actually have decentralized social media, right? That really then makes it easier to understand what the meaning of this technology is, right? And people always talk about, the blockchains remove intermediaries, they increase freedom and all of this stuff. But it's really hard to like conceptually understand that when, if all you're able to do maybe is send money from one person to another. But when you can actually start to see that these underlying, web protocols can be built in a way that's not controlled by anyone, it really just kind of, it's an explosion in your brain about like what the potential of this technology is. So I think that's what I've been most excited. Obviously, there's a ton of other stuff, that is on the horizon. Obviously we hear a lot about like zero knowledge proofs and what that could potentially mean for this space taking off. And again, like I think that the best thing for people that are not technical, right, is actually getting products in their hand that they can then see at how they're working. And I'm really excited about all of the stuff that's on the horizon from that perspective.
Yeah, totally agree. I know we always look at DeFi crypto through the lens of a user, and it still has an edge to it. I keep thinking like at some point, there will just be so much usage out there that like this won't really matter anymore. But to this day, like even some of the smartest people in the space, like if you ask some questions, you start to pick up, you're like, have you ever used a wallet? Like, are you using any of the DeFi? Because you sound a little uninformed.
Like I would just to jump on that, I will say that the one advantage that I had as a lawyer back in 2020 was I basically put some money into the system. And then you remember all the yield farming that was happening at that time, right? So all of a sudden, my economic incentives were, hey, figure out as much of what is going on in this space as possible. And that really then, so you're using all sorts of random protocols that are like Harvest, things like that, right? That all of a sudden, you're getting a much better sense of what everything is going on in the space. So that is, I think, a incredibly necessary step for people that are non-technical to take, is actually using these products so you can see what the difference is between that and, using Venmo.
So before we talk more about the upside and all of like the excitement around, I think there being more friendly regulation to meet the innovation in this space, I do think we should reflect a little bit on like what held the space back. Like I got into crypto in 2017 and I did feel a sense of just being ignored. I felt like the government seemed to just be sort of like waiting it out and not really wanting to like stomp out the crypto industry, but also, not provide like the clarity that we wanted. But at some point, things become extremely negative. And I feel like, it starts at maybe the end of the last Trump administration, and then it really accelerates into like an industry that is clearly being threatened by the Biden regime. What were you seeing at the time that was concerning? What, if anything, was actually holding back the industry, and like, where do we start to see light at the end of the tunnel?
Yeah. So, I mean, it's a really good question, right? I think that for the majority, or for the entire history of the industry, right, we've been dealing with regulators that have been reactionary, right, to what is going on in the space. And as a result of that, they're always going to focus on the things that are most negative, right, and try to stop those things. But it's hard for them to then conceptualize, how do we actually foster the good things, right? And so I think that the SEC in 2017 or 18 was justified in kind of stepping in to try and clamp down some of the ICOs, right? I never worked on an ICO, but I got pitched by a lot of entrepreneurs on ICOs that they wanted to do, right? And people would come to me and be like, "Hey, look, we're gonna revolutionize space travel with blockchains." It's like, I don't think that that is a realistic pitch. So as a result of that, I think they were selling kind of dreams to people and raising capital. Now there were some benefits there, right? You had things like Ethereum come out of it, gave access to a lot of people that ordinarily don't have the opportunity to invest in early stage startups. But there was a lot of risk that was percolating out. I think the SEC did a pretty good job in 2017-18 in trying to kind of stop some of the negative. They also, outlined an optimistic vision of like, hey, look, decentralization is the thing that matters here. Let's try and merge how securities laws work with the concept of decentralization. Now there are some negative side effects to that we can go into if you guys want, but fundamentally the real switch came when Gensler came into the SEC and basically totally reversed the script. It was no longer about trying to create an optimistic vision of what this industry could be. It was more about just trying to eliminate it entirely. And as a result of that, all of the good work the SEC had done previously, basically got thrown by the wayside, and we were, in trench warfare with a very hostile regulator. And so I think, as a result of that, I think we've lost 4 years in the opportunity to really, channel entrepreneur efforts in a good direction. And I think that that's a real pain, right? I think one of the things that we talk about internally a lot, right, is that the last 4 years led to a lot of blockchain projects being designed by lawyers as opposed to designed for consumers, right? And I'm a lawyer, but like I should not be in charge of product design. Like that's not what I'm doing, right? And so as a result of that, you end up with a lot of projects that have maybe made concessions or taken steps that don't make functional sense from a user perspective, but has helped insulate them from some legal risk. So I think we're at an incredible moment now, right, in that we have an opportunity to lay the foundation for a regulatory framework that is really going to unleash innovation, right, while providing investor protection. The SEC liked to say that they were protecting investors during the last 4 years, right, but that's not what they were actually doing. They were actually trying to clamp down on the industry in a way that was going to kill it, and that led to even worse, negative effects for investors that would have happened otherwise by trying to actually support the industry. So, sitting where we are now, we have this unbelievable opportunity, just like with the internet, when it was starting to emerge in the 90s, a solid regulatory framework allowed, the great entrepreneurs that we have in the United States to effectively compete on a level playing field. And that is what has led to, all of these, marvelous innovations. And so we're hopeful that right now is an opportunity for us to actually get a similar type of regulatory framework in place. That doesn't mean an easy regulatory framework, doesn't mean deregulation, right? It means setting clear rules of the road that entrepreneurs can then compete on. And we think that kind of competitive environment is going to be the thing that really helps the industry take off.
So many great points in there, Miles. Something you said that really resonated with me was protocols designed by lawyers. That's been an unfortunate byproduct of this unclear regulation. I want to get into that a bit more when we talk about tokens, but maybe first of all, so again, as somebody myself from the 2017 crypto cohort, there's even back then, there's been this rally cry like institutions are coming, TradFi's coming. Almost to the point that in itself turned into a meme. But we are now on the cusp of seeing it happen. And I feel like people that have been in the space as long as us, you almost like get desensitized to it. And, there's the cliche term zoom out, but you really do need to zoom out sometime and look back at how far you've come, because even today, I'm almost in disbelief as I'm seeing it happen before my eyes. So would love to get your take on what we're seeing with DeFi collide with the broader financial system. And is this a trend that's just picking up steam in your opinion right now?
It is. I mean, I think if you look at the history of the industry, obviously DeFi has been incredible, and it's the fact that it's basically infinitely scalable, right, is just amazing. The problem that I've seen with it thus far is that it was basically stuck in its own trap system where it's recursive on itself, right? If all DeFi is really doing is sitting in an ecosystem that is an economy that's totally isolated from everything else, then its true power, right, you can't really capture it. So it's like having an incredibly powerful engine attached to a car that can't actually make use of it, right? And so I think one of the most exciting things right now is the fact that institutions are, moving into this space. We have the potential to, modernize securities laws, modernize, laws, banking laws, right? Move stablecoins into, a regulatory perimeter. All of that, right, will create greater connective tissue between our, financial system as it currently stands and, DeFi. And as a result of that, the efficiency that DeFi creates, right, the fact that there are no intermediaries, the fact that it's infinitely scalable, the fact that it happens all transparently, all of those benefits are actually going to now start to be realized. And that's, I think if you're looking at all of the opportunities for the sector right now, I think that the DeFi one is the most important and critical because it's the most obvious, right? In the sense that the efficiency gains that can be achieved by moving, part of our financial system on chain are easy to achieve. Right, it's much easier to get those than it is to convince a million users to leave Twitter and go on to some decentralized platform. Right, consumer internet is very difficult, but just pure financial efficiency is inevitable. Right, money is always going to go to where it's more efficient to be deployed, and as a result of that, I think that the opportunity for DeFi is going to be a slam dunk.
One thing that we've really taken notice of is that this isolation of DeFi you mentioned, it's finally the walls are coming down. And, you used to have to be savvy enough to know, I'm going to use DeFi and then I'm going to off ramp and I'm going to take whatever necessary time. There could be a delay of several days. Let's say if you use USDC and then you convert it to dollars in something like Coinbase. But now, I mean, we're even seeing products come to market that are built by DeFi natives. Like EtherFi just released a card where you can essentially borrow against one of your yield-bearing assets like ETH, and then you can spend, your value denominated in dollars. So it basically means I don't have to off-ramp anymore. Or MOONWELL has a U.S. virtual checking account, which is wild. To be able to open that if you're a MOONWELL user who's not based in the U.S. So it's just very, very promising. It means that DeFi doesn't have to continue to exist in its own vacuum. It's a huge vacuum. It's $100 billion of economic activity cross-chain, but it means that we can move beyond this being a tinkerer type market. And now institutions can come on board and we can start to see, DeFi scale to trillions of dollars in value that's transacting.
And also the thing that you're saying too, right, is that one of the real benefits there is increased competition, right, to move people's assets on chain, and that will drive down the price of that transaction, right? Everyone hates, right, moving dollars from their bank account on chain or has over the previous years, because we all know there's a fee that you're going to pay for that, right? And so all of the benefits of once you get on chain and the seamlessness of all of that and the low fees once you're on chain, right, you're still kind of that gateway to getting on has been a pain point. And so I think, as more, as we get clear regulatory perimeter on all this stuff, you're going to see more and more institutions move in, more and more people that are already regulated know how to do all of this stuff. Stripe buying Bridge is a great example, right? As a result of that, we're going to end up with lower fees, more money in the system, connectivity to the real financial system, and as a result, we're going to get it's just going to be massive efficiency gains. So we're really excited about that for sure.
Okay, Miles, I want to go back to what you said about protocols designed by lawyers. We've been in this state where I've felt like tokens have had to be like neutered or powerless almost, or you have to do this incredible lawyer engineering. You jump through hoops, create this Rube Goldberg machine of legal entities to make something happen with the token. So I guess like I want to tie this into we're hopefully back in the fundamentals matter again in DeFi. We've gone through ebbs and flows of that being a narrative, but I hope it's lasting and here to stay now. But a key driver and integral part of fundamentals is you have to have some sort of ability to have token value accrual. You have to give the tokens their power, their true power. So where are we in this right now? Like, are there any guidelines coming down the pike for allowing this more freely and clearly, in your opinion?
Yeah. So, I mean, just to contextualize it, right? So one of the reasons that we ended up here, and I think, look, there are a lot of great lawyers in the space, and I think, if you look at the absolute onslaught of hostility from regulators over the course of the last 4 years, I think generally the industry did a lot of things to insulate itself, and so I think that the lawyers should be taking a victory lap, but at the same time, now we've got to recognize that there is a better path than doing all of those things and jumping through all of those hoops. But so specifically with value accrual to tokens, right? The SEC under Gensler basically, said, look, if you have value accrual to your token, then you're more likely to satisfy the Howey test because now you satisfy that one prong, right? That's the test to determine whether or not securities laws apply. So basically they're saying, look, if you satisfy the prong of a reasonable expectation of profits. And that sucks, right? Because that basically means that lawyers respond to that and say, hey, look, if you just pretend that there's no value that could possibly accrue to your token, well, now you're not going to satisfy that prong. Problem with that, right, is that now people are looking at a DeFi token and saying, well, that's the same thing as a meme coin, even though it's not, right? And that it fundamentally relates to something that has inherent value as opposed to something that doesn't. And so I think one of the perverse consequences of the SEC's approach there led to this now burgeoning market in meme coins and things like that, as opposed to really incentivizing the creation of productive assets and systems related to them. So where are we now, right? I think that obviously the law has not changed yet, but the SEC and its crypto task force have been incredibly constructive in identifying a positive vision for what they see for the space. We've talked to them. I know many other people have talked to them. We've submitted, a bunch of statements to submissions to their request for information, all laying out this argument, right, around why tokens need economic value, and having them, providing them with economic value enables you to do a lot of things, right? For the one thing, the SEC's previous approach saying, hey, this is more likely to treat you as a security. It's the actual opposite is true, right? If you create an economic model for a token that is generated by the programmatic functioning of a network, right? Well, that makes that token economically independent of the devco, right? That built the system, as opposed to, right? Oh, hey, this token has no economic value. Maybe it'll have economic value in the future. Well, now a token holder is just dependent on that team, right? To one day make that asset have any value. So really what we should be pushing for, right, is tokens having economic models, those economic models being turned on, because that's the thing that means that they're more trustless than what they would be if they didn't have economic models, right? Compare that to something like FTT, right, where its economic model was basically hey, look, if you hold this is FTX's token, right? If you hold FTT, you can get discounts on trading on FTX, and then FTX is also going to take a portion of its profits, right, and then go back and buy and burn the token. Well, that system's entirely dependent on FTX, right? And if FTX shuts down, that token price is going to go to zero. That's exactly what happened, right? We also know that people were investing in that token as a proxy, as a way to kind of invest in FTX, right? They were subject to a lot of information asymmetry. Obviously, token holders of FTT did not know that FTX was committing rampant fraud. And then, again, when FTX collapsed, price of the FTT collapsed. So that's exactly the opposite thing that we want. We would rather have economic models that are tied to programmatic functioning of blockchain networks, smart contract protocols. And if you do that, right, and you incentivize the creation of those things, it becomes easier to assess where the value of the tokens are coming from, right? As opposed to, in the case of like FTT, right, where it's hard to discern, okay, like where is the actual value drivers? So there's a lot of benefits that we could have just from a regulatory clarity perspective and mitigating risk to users. But on top of that, right, the real nice thing is that it actually brings some, dose of reality to where these tokens are trading at, right? Because they should be trading at as a product of what the overall success of the underlying protocol is, which should be based on kind of the revenue and network effects that are accruing to that system. So I think, we're super bullish on the idea that this is going to be something that we're going to get regulatory clarity on. We don't have that yet, but, there's multiple avenues that it could arrive, both the SEC providing guidance on this, right, or market structure legislation coming out that incentivizes the creation of these economic models, as opposed to other avenues for tokens to kind of exist.
Yeah, there was clearly a disconnect in the last cycle where all of the tokens that were launching for the biggest names in the space, everyone was clearly investing. I'm speaking from a retail standpoint and actually probably from the standpoint of a lot of funds. They were, investing in that token, thinking of that token as like, the flagship, almost like tokenized equity of that protocol. But then meanwhile, we're getting this very like confusing lack of clarity from regulators, this is again years ago, who are just not telling us what is okay and what's not okay in terms of token design. And so what happens is that void left protocols with this like need to neuter their own token and then leave everyone to speculate around clarity coming in the future. And I think to your point, like what happened is, a lot of token holders end up getting hurt. Like the point of this, supposedly, according to someone like a Gary Gensler, was that like, I guess maybe these tokens shouldn't have existed, or that these protocols like shouldn't be out there pushing a token. But like in the end, everyone finds a way, and it really, it's just very frustrating. I mean, being a U.S. citizen, I contemplated moving. I've got a family, all my family lives here. And I kept thinking, if I really want to work in this space, if I want to see this space progress, like I am living in a place that doesn't want this industry to exist. And so I think people are probably underestimating still that if that sort of regime continues, like I do not believe that, the industry finds a way at some point. Like I think that something like a Bitcoin is too decentralized and would have continued to grow. I think something like Ethereum can, something like a Solana, like they have too strong of network effects, but there are very good people, good founders who got squeezed out of the industry because, of these like frivolous sorts of cases. I mean, when they come after you and investigate you, I mean, those folks are having to pay tens of millions, if not tens of millions in legal fees. And that's enough to get folks to just, shut down.
I think you're totally right. I think that, look, I'm sure you guys have had this experience, right? But when you talk to people that are not in crypto, right, you'll be like, oh, look, this is happening. People are in disbelief, right, that the government would be targeting people in that way, like all of the debanking stuff, right? Which like the industry was screaming about it forever. No one really believes it's going on. Some people still don't believe it was going on, right? But it's like, this is a violation of due process, very clear, right? Government doing illegal things to try and target an industry, right? And the worst part about all of that is that not only was it had worse consequences for the general public, right, than what it would have otherwise had if they had just kind of tried to embrace the industry and channel like all of this energy in a positive direction. Just a couple other points. You're absolutely right about, pushing people outside of the United States. One of the things that's harder to see, right, if you're in the industry, is just what it does to entrepreneurs. And, the number of entrepreneurs that are, look, you have other options. You're coming out of, some college, you have a CS degree, right? What industry do you want to go in? Do you want to go into one where you're going to be persecuted by regulators and do all the things you just said, pay millions of dollars on lawyers, right? All of that stuff. Or do you want to go work in AI, right? And as a result of that, the regulatory environment really did a lot of damage in pushing entrepreneurs away from this space, and we're still seeing the effects of that. And I think one of the reasons why we're very excited about market structure regulation or legislation is that it will signal, right, that this isn't a partisan issue that's going to flip back every couple of years. We actually are going to lay the foundation for an ecosystem to develop. The last thing I would say is another great example of the perverse incentives and the lawyer designed coins, right, was airdrops, right? And like as we started to see, right, people started just blocking US users, right, from airdrops. And it's just like the consequence of the US position on crypto was that ownership of the future of the internet and our financial system was being handed out for free to people outside the US, but not to Americans, even though a lot of that technology was being built here. That's insane, right? I mean, it just absolutely makes no sense. Now, to be fair to all of the lawyers in the space, right? It's a difficult situation to be in, right? As a lawyer working with any company, you only get to say no so many times until you're out of no's and you either get fired or they move on in another direction. So as a lawyer, you are programmed, right, to try and work to yes. And so as a result of that, that's how you end up with all of these weird contortions and concessions, right? Is that it's lawyers trying to be like, well, that doesn't really work, but maybe if you did it this way, like that's and so then the entrepreneurs get dragged along, like, okay, well that doesn't make a lot of, well, fine, okay, if that's the only way to do this, like, here we go. But that's how we got to where we are right now, and so our main goal is trying to kind of erase all of that stuff, streamline the process for entrepreneurs, and have it actually be sensical.
And that brings us really to today, where what was it, just 6 to 9 months ago, we're in a presidential election where I really do believe that any major candidate that came forth that was pro-crypto was going to be able to garner the support of the industry. And in the end, one candidate did become extremely nuanced and pro-crypto, and the other one seemed to ignore it. And I think it was a great signal to those running in the future. Like, you got to get on board with this industry. Like, this isn't a hobby, for these folks. Like, this is the future of finance. I mean, at this point, with BlackRock on board and institutions like Susquehanna and Franklin Templeton, I'm like, guys, like, it's all there at this point. It's no longer a radical decision to align with the industry. Like, we look like just like a fintech industry, on the front side, and then the back side is ultimately crypto and DeFi powered. MANTLE is charting a course towards a future of enabling crypto access for everyone, with major endeavors to build MANTLE Banking and MANTLE Index 4. MANTLE Banking means a new crypto neobank that helps users spend, save, and invest across their fiat and crypto finances, all in one account. MANTLE Index 4 is a tokenized fund in partnership with one of the leading tokenization platforms in the market. You can think of MI4 as the S&P 500 of crypto. To learn more, check out group.mantle.xyz, and thanks to the MANTLE community for supporting us here at the Edge Podcast and Edge Newsletter. Do you have any updated thoughts in terms of providing value back to token holders? Like, is there any safer path to using like buybacks or burns or staking, or if you're not comfortable speaking to like what's safe, like if you can call out any of the pros and cons? Because I think you've made very clear that like change is coming. We haven't gotten that clarity yet. So like, it's not like there are hard and fast rules that you can speak to at this point. But it seems optimistic that we are going to see clarity very soon. So any updated thoughts on some of these like very popular design choices with tokens?
Yeah, sure. I don't want to suggest that my lawyer ideas are the ones. I mean, I think entrepreneurs should be the ones that are making the decisions about what are going to be the most effective tools. I think that we talk a lot about this internally about what are trying to kind of make sure that what we get in a regulatory framework and a legislative framework, right, is going to provide sufficient flexibility for entrepreneurs to be able to explore, do a different, bunch of different stuff. I think one of the things that that we focus a lot on, right, is simplicity. And I think that there's a lot of, when you add a lot of layers of complexity on, stuff starts to become a little bit hand wavy, starts to become more difficult for people to understand what is actually, the economic value that is driving these things, and how do they actually capture it. And so from that perspective, I think, buy and burns are really the easiest to understand, right? Because it's really just about, the changing of the token supply, which is there's a lot of analogs that you can take from the, equities world that makes it easier to understand how those kind of mechanisms are working. At the same time, right, there still are regulatory implications to that. It's a complex problem in terms of, how do you deal with it from a securities law perspective? What are the tax effects of having these mechanisms in place, right? Where are taxable obligations accruing, right? And then how do you layer a, legal entity structure into this to make sure that you can, comply with tax obligations? But I think that the simplest way, to model things is to try and look at like what Ethereum does, right? And they, have a burn mechanism that relates to every transaction. And we think that that's a really good model, and it allows you to model what the price of Ethereum should be based on the revenue of the underlying protocol. So we think that that is a really great system, and one that we would like to see adopted much more broadly. Now, obviously, we still do want regulatory clarity there, so to ensure that that is okay. But we think where we can get that, right, that there is going to be a lot of opportunity to really simplify the story for a lot of these assets and make it clear to people what the value proposition is.
Miles, I want to shift gears here a bit and talk stablecoins. There is something called the Genius Act, some sort of legislation passing. I have to read this because it's a massive acronym, but it's the Guiding and Establishing National Innovation for U.S. Stablecoins Act. Curious if you're following this, and if you are, like, what are the broader implications for the stablecoin sector, which I think everybody in crypto is unanimous in agreement that it's super bullish.
Miles, could you also address just like what was the state of stablecoin regulation to before this? Because I think that'll help lead into like obviously some of the potential solutions it's bringing to the space.
So right now, as things currently stand, there is a lack of clarity as to how stablecoins are regulated. There is a potential, right, argument that they could be regulated as securities. And, that has been something that I think has scared a lot of centralized issuers away from potentially issuing them, right? That's why we don't see a lot of, banks issuing their own stablecoins, or, there are companies that have attempted it where they are regulated. There's a whole bunch of kind of uncertainty in that space. What is the collateral you need? What kind of disclosures do you need to make? Right. So as a result of that, we've seen a dearth of like new centralized stablecoins being issued. At the same time, right, there's a little less regulatory uncertainty when it comes to decentralized stablecoins. And by that I mean, stablecoins that are really related to immutable protocols where, it's all just kind of the collaterals on chain, all of that, not things like going back to Terra Luna, right, where, it was under collateralized, the collateral was endogenous, and that it was kind of created by that system. A lot of it was propped up based on, that anchor protocol that allowed people to deposit in it. So where that starts to get very convoluted away, and I think that there was, reasonable opportunity for the SEC to step in there, even though they didn't. So I think, right, there's generally lack of consensus over kind of where are the regulatory lines here. The Genius Act is a bill that is in the Senate right now. There is a similar bill in the House called Stable that has similarly passed through committee. So we've got, kind of two bills out there that both do a great job of basically establishing what the regulatory perimeter are and what the requirements are for centralized stablecoin issuers, right? So I think that if either of those are passed, then we're going to be in a great position to see really a significant portion of our legacy financial system and institutions, right, start to make use of stablecoins. Stablecoins are a much more efficient tool, right, to layer on top of our existing financial infrastructure. So if you think about, one of the things that people get, I think, confused about or they have a very narrow view of what stablecoins actually do, and that it's just like, okay, well, this is just a dollar. The real opportunity there, right, is that our entire financial system currently is basically a series of networks, right? And there are a series of fragmented networks. And as a result of that, there are, tons of intermediaries that help facilitate, right, movements between those various networks. And that introduces a lot of delay and a lot of cost, right? You want to send some money to someone in the UK right now, you're going to pay a huge fee. So if you think about what stablecoins actually offer and what blockchains do, is they're going to create a kind of universal network on top of all of that, right? Similar to, now that you can send like WhatsApp for text messages, right? Now you can send a message to anyone in any country for free, right? And so that's essentially what stablecoins, the real promise of the network effects of stablecoins are going to do. And so as a result, we're going to end up, I think we'll likely see in the short term a ton of companies moving into this space, both to, create kind of connective tissue between our existing financial infrastructure and stablecoins, but then a lot of companies, trying to launch their own stablecoins. And so it's going to be a real, I think, exciting moment of new use cases coming forward. And, like what we were talking about earlier, a lot of that connective tissue between DeFi and the, legacy financial system actually, starting to really materialize. So that's, I think, super exciting. In terms of where the bills sit right now, I think, I think the Senate is moving a little bit faster. I think they just announced that they want to, get floor time and approve it by or by Memorial Day. So, that we could see really something here, by summer, which I think is very exciting.
Miles, do you think there are a lot of big players waiting in the wings for this sort of news? Like we've seen, some folks step up recently. Like I think Bank of America announced that they would launch a stable coin, or at least said they would launch a stable coin.
Yeah, and I think, I don't think people are necessarily waiting, for all of this stuff to happen. MasterCard and Visa just both announced, huge things with respect to networks. Circle just announced something about, a payment system. So I think there's going to be a significant race, right, to try and take advantage of the fact that we're now going to have this opportunity to modernize our financial rails. I think one of the interesting areas, I'm curious for your guys' view on this, right? Like, one of the ways that I think stablecoins can get network effects, right, is obviously integration with DeFi. That integration with DeFi does take, some effort. It's not that, it's unlikely. Let's say that there are, 3,000 stablecoin issuers as of, a year from now, right? You're probably not going to be able to use those 3,000 stablecoins in Compound, right, or in Aave. And so how do we kind of, how do we merge basically this new paradigm that we're going to be in with all of these stablecoin issuers, right, with DeFi and make it, and maybe it's something like, Curve, where you just can swap in and out of various stablecoins seamlessly. Or, maybe there is, something like, I don't know if you guys are familiar with like M0, where they're going to, trying to create a single stable coin for multiple different issuers, right? Or are there clearinghouses that are going to kind of like, so I think it's a really interesting, there's a lot of different avenues, right, where we could end up with, one of my colleagues, Sam Brunner, calls this like the singleness of money. And that like you need a stable coin basically to truly equal a dollar, as opposed to, fluctuating a little bit on the edges. And so there are various ways to get there, and I think it's going to be interesting to see that play out.
I think M0 is such a good example of like where the future lies. Abstract away all the complexity from the tech side and allow teams to focus on, using their network, their liquidity, think strategically about designing like the best product or like the best yield. Like the days of having to be like a Swiss Army knife type of founder, with stable coins, like these big banks and like institutions, like they don't have the time or the bandwidth to be, working in the weeds like the way that like a founder like Circle was, many years ago. So it's really exciting. What about in terms of launching? Like my assumption, given the absolute dominance right now of RWAs and stablecoins being on Ethereum mainnet, is that we'll continue to see a flood of liquidity moving on to Ethereum mainnet. Do you have any thoughts on like what else do institutions or banks need to see in order to start to experiment with like an L2 or experiment more with, Solana's another L1 that has some liquidity coming onto it in the form of RWAs and stablecoins, but all of this pales in comparison to Ethereum mainnet. I mean, it is absolutely like the default choice for these big capital allocators.
Yeah, I mean, I think so. It's a really interesting question, right? I think that one of the things right now that, is a North Star kind of goal for a lot of projects is like getting an IPO on chain or something, right? But there's a lot of things that need to happen before that can take place. One of the things that the SEC, should be focused on right now, and they asked about this in their request for information, was, what do we need to do to modernize securities laws in order to enable, actual securities to trade on chain, right? And there's a bunch of stuff that they can do, and that would, mitigate a lot of the risks of transfer agents. It would just kind of create a ton of efficiencies. So that feels like pretty low hanging fruit to me in terms of opportunity to get the regulation right. There's broad consensus that at the end of the day, a lot of the securities that exist in the world, right, are just tracked on a ledger that is, an Excel spreadsheet or the equivalent, right? Blockchains are ledgers. It's pretty easy to just say, hey, let's just move this system onto here. So I'm really excited about, I think that opportunity. And at the same time, though, I think, it's one of the things I've always, that's always been challenging when working in crypto, right, is that like a lot of these problems of the legacy system, a lot of the solutions that blockchains offer, right, are transparently obvious, right? But the coordination problem of actually getting everyone to move in a single direction is very, very difficult. And so even though that the solution exists and is possible, does not mean that it's guaranteed, right? And so I think that there's a lot of entrepreneurs right now who are fighting to kind of be the ones that break the mold and start to bring these securities on chain. I don't know that that's going to happen, with an IPO. I think that that's a harder target. There's not a lot of IPOs these days, right? But I think that there are a lot of other types of securities, corporate bonds, things like that, that could move on chain where they already have a lot of like issues in terms of secondary market liquidity, things like that blockchains could help resolve. And so I think we'll start to see that. Securitize is a company that's obviously been working in this space a lot. So I do think that as we start to get more of those assets, RWAs on chain, that again, that's going to benefit DeFi because it obviously the power of DeFi can then plug into those systems. But I think it's not clear to me yet who's going to have kind of the first mover advantage and where it's going to accrue. You could obviously see like, a Goldman Sachs launching a permissioned L2 that it then, kind of basically keeps all of its assets on and things like that. So you could start to see stuff like that happen. But it's I think one of the things that they're going to want transparency on is very clear regulatory framework. And I think that probably means we need legislation before we really start to see the biggest players in the space move in size.
Hey folks, I want to tell you about our sponsor, GEARBOX, the protocol that reimagines on-chain lending. With GEARBOX, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about GEARBOX, go to gearbox.fi.
Egg. A quite astonishing commodity. The cause of your desire. Egg. Which fills the inner void. Egg.
Eggs are pretty epic, but you know what's more epic? Paying for them with crypto. Borrow, earn, and now pay with MOONWELL.
Say hello to Puffer UNIFI. Puffer Finance is expanding beyond native liquid restaking with new products such as UNIFI-based ROLLUP and UNIFI Pre-Confirmations AVS. UNIFI is not just another L2. UNIFI is a based rollup, one that will solve L2 issues, such as slow withdrawals versus instant withdrawals with Puffer UNIFI. Puffer UNIFI is fast. capable of sub-second transactions. UNIFI also has boosted puffer points, which means if you bridge assets, you earn boosted puffer points and rewards from dApps on UNIFI. Puffer's core products mean a bright future for Ethereum. Learn more at puffer.fi.
Miles, something I think about a bit is these centralized stablecoin issuers and these decentralized stablecoin issuers. They're kind of like coming at the problem from different ends of the spectrum. So you've got the centralized players maybe eventually merging into DeFi. You've got the decentralized issuers merging maybe into TradFi or retail. I wonder who has the better advantage. I think it could be the people with the most distribution, but I saw an announcement just today before we hopped on that's probably worth bringing up because it uses a lot of the language you've already mentioned, but it's Athena and TON. So Athena is tapping into the 1 billion users on Telegram to send payments. And it was funny because Guy, the founder, said users can now send, save, and spend as easily as sending a message. Pretty much exactly what you just said with the WhatsApp analogy. But I think about kind of tying this back to regulation and you know, the Stable Act and Genius. This is a yield-bearing stablecoin. And you know what? They don't even like stablecoin. It's synthetic dollar, whatever you want to call it. But is this... I'm seeing a ton of these pop up. It's like there's a new yield-bearing stablecoin almost every day, almost as many as L1s are popping up. But is any of that regulation like capturing this emerging kind of asset class of the yield-bearing stablecoins as well?
So the way that you know, both Genius and Stable, the two bills, approach the problem is they're basically saying, look, we're really only going to target, you know, centralized stablecoins where you have a centralized issuer, and I think that is the best kind of initial target, given that is the most high trust relationship that you could possibly have, right? Those people all control all the collateral. Right, they control the issuance and redemption mechanisms. As a result, right, they are a very high trust relationship that introduces a lot of risk, and as a result, that should be the primary target for regulation at the outset. On the decentralized side, right, I do think that there is there's a need to be a little bit more flexible and cautious with kind of applying a regulatory framework, because you could ossify things, and maybe we should actually be incentivizing innovation rather than trying to kind of keep things in a box. I would say, one of the interesting things that could arise from the way that stablecoin legislation is trending is that obviously they've kind of restricted the ability for those stablecoins issued, under that regulatory framework to be yield bearing, and decentralized stablecoins don't necessarily have the same restrictions in place. But if you look at, the SEC recently put out some guidance on stablecoins, right, and made it very clear where there is no yield-bearing element to it, that they're very unlikely to be regulated like securities. But the inference from that is that where there is yield, the SEC might take a closer look. And so when you start to talk about, various stablecoins that exist, that are issued by smart contract protocols, right, I think you have to start to look at, okay, where they are yield bearing, where is that yield coming from, right? And in the case where that yield is coming from, let's say a, immutable smart contract protocol that facilitates, borrowing and lending of assets, or like, how Maker was originally designed, where people are depositing, ETH and it's over collateralized. I think it's very easy to get comfortable with that yield because everything is being done autonomously and transparently on chain. Now, some of the other stable coins that exist in the space now are kind of pushing the limits on that analysis a bit, right? They are deploying collateral, an intermediary is taking control of that collateral, deploying it to earn yield. And where that is the case, you're introducing risks that users need to be aware of and potentially guarded against, right? Because, the idea that those systems are trustless just is no longer the case. And so I think, I do think that the SEC is going to be more proactive in that area. They've obviously put out guidance recently, but at the same time, I think they want to foster innovation, but that doesn't mean that you can kind of just, turn a blind eye to some of these systems that might be introducing a lot of risk to users. A great example, right, is Terra Luna, which, I think was promising users, 20% interest on their stablecoin deposits. you gotta, I mean, you guys know this as well as anyone, right? Like you gotta look at where is the yield coming from, and that's a critical. I mean, that's almost a meme, right, in the space. And I think that's something that needs to be guarded.
Miles, you were touching on RWAs and tokenization earlier, and you mentioned securitize. We're filming this a few days after I saw another big announcement where BlackRock filed to tokenize shares of another 150 billion treasury fund with BNY Mellon or something like that. Just curious, like you, maybe A16Z looking at this, is this like, I mean, is this a narrative? Is it a trend? Is this real? Is it something that you're internally excited about, I guess, at A16Z?
Yeah, I think we are. I think there's great progress to be made here in bringing efficiencies to to our legacy financial system. I think a lot of people don't. It's very hard and opaque to see where the inefficiencies currently are. So to understand kind of what the opportunity is, right? But if you just think about like right now, securities transactions settle in T+1. Right. What that means is that you have a transaction and then the settlement actually occurs a day later. Right. And what that requires you to do is basically hold money, right, ready to settle the trade the following day. And then that's when the assets move. And so, that generally is a waste of capital over that period of time. Right. It used to be when I first started my career, it was T+5. Right. So you'd have to have that money sitting there for 5 days. And so as that leads to a lot of inefficiency, and it leads to people having to collateralize transactions, and that just sucks up a ton of value out of the system where capital could otherwise be deployed. And so once we start to see kind of assets move on chain and the ability for atomic settlement, right, which is instantaneous as opposed to T+1, that is going to unleash a ton of capital that is currently locked in the system and not being productive. And so they're just for our overall, for the U.S. economy, this is a great thing. It means that everything is going to be functioning more efficiently, but it's also an incredible opportunity for, companies building in the blockchain space. So, one of the things that we're most excited about in that area, right, as more and more assets become tokenized, more RWAs come on chain, right, things like DEXs and lending protocols become incredibly interesting, right, because we all know, right, a DEX right now can scale infinitely. And as a result, every single, asset that gets tokenized could find its way into a DEX. And that is going to be a much more efficient and decentralized, trustless operation than what we currently have with existing, trading platforms. So there's a massive opportunity there. And I think, we will just continue to see that play out. Again, I think market structure legislation, the SEC's crypto task force constructive approach to tokenization is going to, really unleash a lot of potential here. The SEC Crypto Task Force is about to have a whole, roundtable on tokenization of assets. So this is something that they're thinking about, obviously something that they're very familiar with, right? And I think that everyone kind of sees the opportunity here, and there's general consensus that this is just going to be better.
Okay, so among the different RWA-like assets, and I'm looking at rwa.xyz. So if anyone's not familiar with that, it's a great website to look at on-chain analytics. I'm going to throw out stablecoins or yield-bearing stablecoins as a choice here. But like among some of these different major categories, I'm wondering like which of these do you think is most likely to see the SEC turning more favorable, sort of just like greasing the wheels to allow for greater adoption? And actually one of them that's not on here, I can toss in is tokenized real estate. I've always been super excited about. That's been a use case that has always been talked about, and there's been some like really brave pioneers that have tried to work on it. I'm not sure there's ever been like a real breakout in that, but I guess there's like tokenized real estate, there's bonds, private credit, commodities. We talked about tokenized stocks, institutional funds. Any one of those that really jumps out at you based on your expertise that you think second to stable coins, this class of RWA is absolutely due to explode in growth?
Yeah, so I think two parts to that, right? I think you can, on the regulatory side, right, basically solve all of the problems at once, right? Just by modernizing and making it people able to move these assets on chain, right? Any security on chain. And so I think that there's not, we don't need to be incremental basically in how we approach RWAs. We don't need to pick which ones we want to bring in. The stablecoin thing, right, is obviously being called out separately because that's kind of an asset that doesn't really exist in the world today, right? And so there is a new regulatory framework that's needed. But for all of the existing securities and how they trade on, paper ledgers now, right, you can just modernize rules and open up the door for all of them to then trade on chain. Now, specifically with respect to RWAs, right, I think, more niche markets, right, are likely the ones that are going to move on chain first because the complexity of the coordination problem, right, of moving those assets on chain is easier. So, for instance, right, if you just conceptually thinking about that, right, if you have a market that has 1 million assets in it, right, and 1 billion participants, right, moving that market on chain is going to be much more difficult than moving a market that has 10 assets and 100,000 participants, right? And so if you think about the coordination problem of how do we move these markets on chain, I think it means, right, that, and I'm just speculating, right, I think it means that those smaller and more niche markets are the ones that are actually going to become on chain more quickly, right? The ones that have liquidity problems because there aren't a ton of investors. So stuff like corporate bonds, private credit, all of these things I think are more likely and more effectively able to be tokenized given that the markets are a little bit more fragmented. Moving NASDAQ on chain is a much more substantial and significant problem, and it's one that's going to take a lot more buy-in. So that could be a very years-long problem, right? Whereas some of these other things I think could happen quite quickly.
Miles, we were talking a bit offline about this new DAO model that you mentioned. I don't know a lot about it. I purposely didn't ask you much about it because I want to find out live here. But I do know that DAOs have had their problems. So keen to hear if you think there's some better solutions in the works.
Yeah. So I think one of the things that you said earlier that was totally right, was, you now have these convoluted structures where people have, a different project will have 5 different entities, foreign foundations in random jurisdictions, and all of this is like done, and people don't really understand why, and it's like super complicated. It obfuscates a lot of like, okay, who is actually controlling these systems, who's doing what, who's responsible for what, right? And as a result, I think there's a lot of complexity there that you just don't see in any other industry, right? There's not startups in a bunch of in AI or wherever, right, where they have a Cayman Foundation, a Swiss Association, and a Panama Foundation, right? Like that doesn't exist. So one of the things that we, are very focused on is trying to streamline the process for entrepreneurs so that you can basically rapidly iterate, and go through cycles. It shouldn't, require $500,000 to set up some, bespoke structure to launch a token and launch your protocol, right? So the one of the ways to do that is this new legal entity structure in Wyoming called the Decentralized Unincorporated Nonprofit Association. So we call that the DUNA for short. Now this is an entity structure that's based on an entity that's called an UNA, Unincorporated Nonprofit Association, that exists in about 30 states. But the goal behind the DUNA is basically very simple, right? Where you have token-based governance, the DUNA provides you with a real-world entity, right, to provide some protection and real-world connective tissue for that token-based governance, right? So that means an entity that could pay taxes to the extent that token holders own them, can represent the token holders in court to the extent that there's litigation. And basically, provide some liability protection. So what we've seen over the course of the last couple of years, right, is plaintiffs' firms have become more and more interested in this space. They're targeting token holders, they're targeting DAOs, right? And it's very difficult to deal with those cases because who shows up to represent them, who's part of the DAO, who's not. Does it depend on whether or not you voted, right? How much participation means that you're in it. And as a result, it's kind of put I think a black cloud over DAOs. Generally, look, I think there was a lot of fanfare over DAOs in when they first came up, and generally, I think their token-based governance shouldn't be relied upon to do too much stuff. But there is real value in token-based governance, and it's one of the key things that I think we need to be able to protect in order to have these protocols be truly decentralized and able to, but able to evolve over time. So the DUNA is one kind of avenue that will help protect that. It's also key to be able to really explore a lot of the economic models for tokens, right? Because some of those economic models could lead to, potential tax consequences, right? And as a result, you want to be able to actually comply with tax obligations. But fundamentally, just, taking a step back, right? I think if you look at the way that the industry developed over the last 4 years, right, was to, again, going through all of these lawyer, inspired contortions, right, that we hopefully are just no longer necessary. I think one of the funny anecdotes that I've heard about all of that was that, like, it's now, difficult to find Cayman lawyers to help you set up a foundation because all of the Cayman lawyers are now sitting on foundation boards and getting hefty paychecks for doing so. That is not, I don't know about you guys, but that's not the idea of what, like, blockchain technology means in my mind, right? So I think we've ended up in a fairly contorted situation now that we have, a lot of pro crypto movement in across policymakers and regulators. I think the opportunity is really to solidify the industry's presence in the United States and provide entrepreneurs a clean path to innovation. And I think that the DUNA is a key part of that.
Before we wrap up, I want to talk just a bit more about this idea of solidifying the presence of crypto in the United States. So I have a few friends who have reached out and, clearly would not have voted for the sitting president, but are recognizing that the administration has been very pro-crypto. So they're happy with those results. And I think what they're worried about, and honestly, I'm a bit worried about this too, is that all of that progress could be undone if crypto is seen as a partisan issue. Like, I want it to be a bipartisan issue. I personally believe it is actually a bipartisan issue. So I'm asking you, like, what's your thoughts on this? Like, is crypto a bipartisan issue, or is it at risk of being a partisan issue that one party runs on and the other party looks to undo all that progress?
Look, I think that there's certainly risk of that, but I think that perception is not reality at the moment, right? I think that people view it as being a very partisan issue. President Trump has done a fantastic job of outlining an optimistic vision for the industry and an effective way to kind of deliver on that vision. And there are those in the Democratic Party that have, very loud, outsized voices that want to capitalize on that perspective to basically criminalize the industry and continue the same failed policies of the last 4 years, right? But I think if you talk to, most Democrats, their perception is very different from what, is being voiced by those loud voices. And a lot of them are very surprised to learn about the depths to which the Biden administration really targeted the industry and recognize that was a very significant mistake. It wasn't, it hasn't been the case for the last 25 years or 30 years, right, that the Democratic Party was, anti-tech. And really, it was just over the course of the last 4 years that changed significantly. And so I don't think that was driven by large, broad consensus across the Democratic Party, right? I think it was a couple loud, powerful players pushing in that direction. So taking a step back, right, I would say that crypto is actually the most bipartisan issue in DC right now, right? There was a CRA that was approved rolling back the IRS broker rule that received widespread bipartisan support. I think these stablecoin bills are likely to get widespread bipartisan support. And when you go and talk to, members of Congress, there are now more pro-crypto members of Congress than there were, 3 years or like last year, right? And so as a result, I think we're in an incredible moment, right, where, again, we have bipartisan support for the industry. People can see its value. People can see that new regulatory frameworks are necessary in order to protect consumers and to unleash innovation. And so while there's a lot of noise out there, there's a lot of noise in the space generally, right? The actual signal is that this is a bipartisan issue, and we're hoping that it stays that way.
Miles, I think that was a great way for us to close out the conversation. So for our listeners, I want to remind them that they should learn more about your team at a16zcrypto.com. They should follow A16Z Crypto on X, follow Miles Jennings on X, We'll put that into the show notes so you can reference it. And then, Miles, thank you for coming on. Thank you for teaching us so much here. This is clearly outside of our expertise. Again, I feel like as users, we know the pain points and like the impact of regulation on crypto, but we are very grateful to have someone with your subject matter expertise to be able to learn from. So any final word for us before we go?
Just thanks for having me, guys. I think this has been a great discussion. I mean, yeah, really, we're so focused here on kind of what the opportunity is, and I would say right now is really the moment to be very optimistic about the future of this industry, both from the technology that's being developed, but also because we have this chance to get a regulatory framework in place. So really appreciate everything you guys do, and thanks for having me on.
Thanks everyone for tuning in. To stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.